All right, let's dive into one of the most famous and, let's be honest, most controversial theories in all of finance, Elliott Wave. For almost 100 years, you've had traders who swear by these patterns. They see them as this secret roadmap to getting rich in the markets. But is it a real analytical tool, or is it just financial astrology with extra steps? Well, today we're going to dig into the evidence and find out for real. And that really is the bottom line, isn't it? Let's just forget about all of the complicated charts and the fancy jargon for a minute. The only question that really matters is this. Does this theory actually help you make more money? That's what we're here to answer.
So here's our game plan. First, we're going to break down what Elliott Wave Theory even is. Then, we'll look at the actual academic evidence that says, hey, maybe there's something to this. After that, though, we're going to expose the theory's fatal flaws, check out the hard numbers on its performance, and then, finally, we'll deliver the verdict.
Okay, first things first, before we can start judging this thing, we really have to understand what it's all about. So let's unpack this 90-year-old idea. So way back in the 1930s, this analyst, R.N. Elliott, he looks at the stock market, which seems totally chaotic, right? And he says, no, wait a minute. It actually moves in predictable repeating patterns. He believed it was all driven by the natural rhythm of human psychology, that constant swing between optimism and pessimism. And the core pattern he found was this 5-3 structure. You get 5 waves pushing with the main trend, and then 3 corrective waves that move against.
Now, look, it is so easy to just dismiss this as a bunch of random lines on a chart. But believe it or not, there's a whole body of academic work that has actually gone looking for these patterns. So, to be fair, let's look at the case for Elliott Wave.
And at first glance, the academic support is actually surprisingly strong. You've got peer-reviewed studies from all over the world, looking at totally different markets, from Indian stocks to US equities, and they found these wave patterns in historical price data. There's one study from 2012 that's really interesting. It found the theory was actually pretty good at predicting things during the absolute chaos of the 2008 financial crisis. The idea is that in times of extreme fear or greed, that crowd psychology gets more powerful, and because of that, maybe more predictable.
And this number, wow. This really drives the point home. A 2018 study used machine learning to scan currency charts and was able to identify classic Elliott wave patterns with an absolutely incredible 99.43% accuracy. So here's the thing. The patterns are definitely there in the historical data. But, and this is the most important but you're going to hear, identifying a pattern in hindsight is a completely different universe from being able to predict one in real time.
And this right here brings us to the absolute core of the problem. This is where we get into the theory's fatal flaws. Just because you can spot these patterns after they've already happened, well, that doesn't mean you can make any money off of them. Okay, so that academic support looks pretty good, right? That 99% accuracy figure sounds amazing. But there is one single fundamental problem that basically threatens to bring this entire theory crashing down. And this is it. It's all about subjectivity. Think about it. If you use a simple tool, like a moving average crossover, the signal is objective. Every single person using the same settings gets the exact same buy or sell signal at the exact same time. You can test that. But with Elliott Wave, it's the total opposite. The rules for counting the waves are so loose that 2 world-class experts can look at the very same chart and come up with completely different and equally valid interpretations. One might see a super bullish 5-wave pattern starting, while the other sees a bearish corrective pattern. They can't both be right.
And this subjectivity, it just creates a whole cascade of problems. First, you get massive hindsight bias. The patterns always look absolutely perfect after the fact. Second, it makes the theory impossible to prove wrong, what scientists call unfalsifiable. If a prediction fails, an analyst can just say, oh, my mistake, that was just an alternate count. There's always an escape hatch. And that means you can't systematically backtest it. If the rules are totally flexible, you can never prove if the strategy actually worked in the past or not.
And hey, don't just take it from the critics. Listen to this. This is a quote from someone who worked for 8 years at the biggest Elliott wave analysis firm in the world. They admitted they constantly had to bend the rules because the market simply didn't do what the theory said it was supposed to. That's a pretty powerful admission coming from a true insider.
So we know the theory is subjective. It's kind of impossible to test cleanly. But let's just put that aside for a second and ask the most important question of all. When people try to use it anyway, what do the numbers say? Does this thing actually make money? Well, the data is not good.
Studies have found that even the most experienced traders using this theory only have a success rate between 35 and 55%. I mean, when your success rate tops out in your 50%, the critics are absolutely right to say you might as well just be flipping a coin.
But here's the real kicker. It's not just that the accuracy is no better than random chance. The strategies actually lose money compared to the simplest strategy there is. Over the last 2 decades, traders using Elliott Wave have, on average, underperformed a simple buy and hold strategy by 2 to 3% every single year.
So why is that? Why is the performance so bad? Well, one big 18-month study found the answer. They found that even when they could identify wave patterns, in 65% of the cases, those patterns were just too inconsistent and unreliable to be used for actual trading. The theory was only maybe useful on about a third of the things they looked at.
And this chart just puts it all into perspective. If we say a simple buy and hold the S&P 500 strategy is our baseline, that's 0, the average Elliott Wave strategy doesn't just fail to beat it, it actively loses to it by about 2.5% a year. And that's before you even think about trading costs and commissions, which would make the results even worse.
Okay, we've seen the theory, we've looked at the evidence for it, we've picked apart the fatal flaws, and we've checked the hard numbers. So let's pull it all together and deliver the final verdict.
So, what's the verdict? Well, the answer is actually a little bit nuanced. As a way to tell a story about what the market has already done, as a descriptive tool, it can be pretty compelling. But as a system for predicting what the market is going to do next, the evidence is crystal clear. It fails. The accuracy is no better than a coin flip, it can't be scientifically tested because there's always an excuse for a bad call, and its subjectivity makes it a perfect trap for our own psychological biases. So what you should really take away from all this is a very practical point. Given that the strategies underperform and the theory itself can take years to even pretend to master, the time you spend learning Elliott Wave has a negative expected return. You would be statistically, demonstrably better off putting that time and energy into a simple index fund.
And that just leaves us with one final, very pointed question. A system that can explain away every single failed prediction by just saying, oh, that was an alternate count, that's not a strength, it's its greatest weakness. It really forces us to ask, if a system has a built-in excuse for every single failure, are we really dealing with market analysis, or is it just a more sophisticated form of astrology?